these taxes often distort buyer behaviour. And already we're seeing that on the ground.
I mean, tax should support a good investment, not create one.
The Great Australian Dream is still alive, but what we've realised is that there's more than one Great Australian Dream.
Every meaningful financial decision comes down to a considered move. The right structure, the right timing, the right tax advice before you act, not after. Welcome to The Considered Move, the podcast from Andersen in Australia. Over this series, we're working through the tax and advisory questions that matter most, whether you run a business, look after family wealth, or perhaps you advise the people who do that. I'm Callen Dendle, National Tax Director at Andersen, and I'll be guiding the conversation. With me across this series is Cameron Allen, Chief Executive at Andersen in Australia. Cameron brings the firm's view to each conversation and turns the technical changes into what it means in practice. Joining us today is Richard Temlett, National Executive Director of Research for Charter Keck Cramer, one of the most widely quoted voices in the Australian housing market, and whose work turns the property data into the calls developers and investors actually need to make. Today, we're going to be talking about property and where the pressure is following the budget changes. The question we're hearing a lot in lots of different versions is negative gearing and capital gains tax changes. What does it mean? Is the property market going to turn? Has it already turned? And where should I be moving? That's where we're going to be headed today. But first, let's start with a lay of the land. Cameron, could you take us through a bit of a highlights package of the changes in the budget?
Sure, thanks, Callen, and welcome, Richard. It's great to have you here. Look, the property reforms are really two reforms working together, as you've sort of touched on. From 1st of July 2027, negative gearing for residential properties proposed to be limited largely to new builds. And at the same time, the CGT discount, that will continue for new builds, but essentially be replaced with indexation, or have a choice certainly for new builds. But for older stock of property, negative gearing is effectively off the table. So existing investors are largely grandfathered up until the date of the announcement, but future investors face a much different landscape. I'd probably also like to touch on as well the existing build-to-rent rules and MIT changes as well. And I know, Richard, you probably have some information to share in this conversation about those. So, but I think the real issue is not really tax, but more around whether investor behaviour will change, and that will have the flow-on effect, I think, for certainly developers and I guess the property market more generally.
So these are some pretty significant tax changes, but as you mentioned, the real impact is how it flows through to the property market. Cameron, you look really at what has changed in the tax rules, whereas Richard, you're looking more downstream about how that impacts the developer or the end investor. Where do you think those two views are starting to line up, and where do you think they're diverging?
These changes, in my view, certainly, and with almost everyone that I've spoken to in the industry, are some of the biggest in the last 10, 20, or even 30 years. And there's a significant amount of uncertainty out there right now, as there always are when significant changes come through. The devil certainly is always in the detail, and we still need to actually wait until some of these changes are fully legislated and we can actually analyze that detail to truly understand what's going on. To answer your question, right now, what we are really very quickly looking at is, depending on whether you speak to the developers, the financiers, the sales agents, it's actually understanding the particular asset class or sub-asset class that you're looking at, whether it's an apartment or house and land, understanding who the buyer is, whether it's an investor or an owner occupier, because those changes, a lot of them at a high level, they are probably well-intentioned, and we know what the intention of the government is, but they have a number of unintended consequences that are likely to flow through. Investment and development decisions need as much certainty as possible. So I suppose at least we know we've got dates as where everything's likely to start or change. That's the first important thing, because people right now are going, well, do we put our investments on hold until that period of time? And the answer is yes. You will see, like we've seen with other announcements, when certain dates arise, there's either a pull forward or a push back of demand, because investors are, for the most part, very smart or well advised. and they'll either make the decisions before or after the change in these deadlines. So the first thing is at least we've got certain dates. There's still so much uncertainty as to what the carve-outs are going to be. It's actually quite difficult to fully answer that. The government has done at a state level a good job with planning changes, but with tax, which is certainly more at the federal level, it actually is very nuanced. And I suppose one of the takeouts that I encourage our listeners to just keep in mind is when you read the media headlines and they say things like the property market is going to crash or investors are going to leave, that's not correct. It's not correct, or it's not necessarily correct, because it is always submarket specific. And the advice we're giving is do your detailed due diligence, because what we've found is that there's winners and losers. Certain subclasses will actually be the beneficiary of these changes. For example, build to rent or house and land. There will be other losers. For example, mom and dad investors. And a number of them were already leaving the housing market before the capital gains tax and federal capital gains tax changes and the CGT were imposed, because there was additional legislation put in place. That in certain markets will continue to occur because people can't negatively gear anymore, as has been described. So it's hard to really line up and go, well, where is everything aligning? Because with respect to the government, I don't think that they truly understand how the housing market works. And I don't mean that in a condescending way. It's actually much more sophisticated than probably people give it credit for. It's not something that changes overnight, particularly when you look at demand and supply. Demand can change very quickly. Overnight, people can make a decision to purchase or not purchase. Supply takes a number of months or years to actually build. And so that's probably the largest misalignment right now, where if you've got buyers who are not making a decision, you can't necessarily then get pre-sales for projects. You can't then get the funding to build them out, and then stock doesn't get built. And then prices or rents actually increase. And that's actually what's happening now with the government. They're starting to stress out, going, well, we're seeing auction clearance rates. We're seeing them fall off a cliff. Some of them are turning around and going, well, it's actually because of interest rate rises and the war in the Middle East. And it's difficult to also unpack, to go back to your question about where do they align. It's difficult right now with 4 or 5 huge metrics changing right now. And let's call a spade a spade. The cash rate changing has a huge impact on the market. The war in the Middle East and just the geopolitical uncertainty also is huge for uncertainty. And then you've got these changes overlaid. It's difficult to specifically say this is the particular percentage change or impact that it's had. So
it's never easy to say it's one driver or another.
No.
There's a lot of impact across a range of things. Cameron, from your perspective, with a change like this, in terms of the client base you're talking to, who's feeling it first at the moment, and do you have a view in terms of, to Richard's point, the lag in terms of the tax change and implementation and how that's playing out at the client level at the moment?
Yeah, look, it's an interesting one. I think clients are just sitting back and assessing. They're not necessarily making any decisions. But to Richard's point, I think there are many different drivers. To name, obviously interest rates, the cost of building, the war in the Middle East. These types of things are, I guess, sort of more macro and micro to some extent. But tax will influence, I guess, behaviour to some extent, and that can have a flow-on effect, because a lot of developers, for example, they're dealing with trading stock, so it's a different proposition for them. But at the end of the day, it's part of their supply chain. So if they don't have the customers and the tax changes are driving that, then that's not good. So we can sort of see things stalling, and then we've got obviously the way the changes have been targeted for existing property. I guess it's whether or not people are going to exit those investments, or will they just retain it because, essentially it's going to be grandfathered for if you're in individually geared property prior to the budget date time, the 12th of May. You're okay, so you can continue. But we're not talking, a lot of these rental properties, it's not like a big portfolio. There are exceptions, of course, that are negatively geared, but usually it's 1 or 2, and it's usually a mum and dad investor. So I think it remains to be seen as to whether these changes will actually determine the market to some extent. And that's a supply consideration. But importantly, whether or not there's the imprimatur or the conditions that allow developers to, create new housing that is set to meet the demand and, I guess, the national crisis issue. And all of these changes have been developed to target, or at least to ameliorate and fix. So, I think the tax is part of it, but it's not the whole story.
It's not the only reason that anyone will make a decision.
Not at all.
Just to build on that, actually, as we were talking, I've realized now a lot of the work that I do and the advice that I give to clients, and certainly this is another message for everyone listening today, you need to understand your target markets and then target your target markets. I say that all the time. What do I mean by that? Well, if you are selling to a buyer, or if you are trying to do a commercial office development and you've got a tenant, that's your target market. And these changes have a significant impact on the target market, particularly the buyers or renters, whether it's for residential or any of the real estate asset classes. So the first change will actually be on them and their behavior. And it's a very, very well made point. These taxes often distort buyer behavior. And already we're seeing that on the ground. There's examples of buyers in, for example, the house and land market going, fantastic, I can purchase a house and a land package. I get capital growth in the land, so I'm going to proceed. And then first home buyers are also beneficiary with some of the additional incentives that they get in this budget. So there have been house and land packages that have been the beneficiary of these changes. But it always comes down to going, well, who is your target market? Who are the buyers? Who are the investors? Their behavior, which can change very quickly, as we know, that's the demand side, very elastic. It can change, and it has changed very quickly. That's the first point in terms of identifying and mitigating risk, is to go, well, who are we targeting? How do we anticipate that they're going to behave in response to these changes, linking back to the asset class? The next segment of people that will be impacted are most likely the developers, because they're the ones obviously carrying the risk, making a decision about whether to proceed with their projects. Asset classes, as I said, like house and land packages or build to rent, which was carved out. And the end users, being the renters, are, I suppose, less affected there. They've just got to obviously worry about paying the rent. But the developers and then the overseas or local capital, they've actually received very positive signals going, fantastic, we actually have clarity. We know that we've been carved out of these changes so we can proceed. There might be other issues that we still need to grapple with, but MIT's been changed in their favor, which makes it much more attractive. Hopefully, GST also gets changed, because that will then make the financial equation for build to rent just more viable, and the economics will start to work. And then, so that's really build to rent. And then also social and affordable housing is another winner, because there are still incentives in there that work. But it's then the end users, being the mom and dad investors, even first home buyers who are with the interest rate rises, or the fact that they're reading the headlines now and going, well, why would we want to take out or take advantage of the first homeowner grant or the government guarantee on a 5% deposit when we are worried that house prices may fall 10% and we go into negative equity? And that's, even if it's a media headline, most buyers are not fully educated. They're not all property analysts. I accept that. And they'll freak out and they'll go, well, these are some of the biggest investments or purchases in our lives that we're making. We're not going to make this overnight. And we're terrified when we read the newspaper headlines of us going into negative equity. And so as a result, across all markets, there has been a slowdown and caution in buyer behavior. It's most pronounced in Victoria, but that is, again, is because of overall weak sentiment, which is such a shame. But overall, even in the more stronger performing markets, whether it's Brisbane or Perth, there has been a slowdown in certain sectors where buyers have just gone, let's just take a deep breath, let's just actually see what's going on. And it's that uncertainty, it's that buyer behavior that we really need to understand. And when we get more line of sight on that, finance then ultimately will start being able to make those risk-adjusted decisions.
In terms of the segments that you mentioned, are there pockets that are still performing well through this? So maybe is that downsizers looking at certain types of higher end apartments, or is there other specific development sites that, with Victoria as an example, are still performing well? Not everything is down?
Again, that's another important finding from our research. There's not one size fits all. There's not one blanket statement that can be made that this change means a certain outcome for all asset classes. Absolutely. there are, as we know, there's subsectors or submarkets within markets, and some of them are performing well. As I said, house and land, built to rents, affordable housing, those are the ones that have performed really well. In terms of the downsize or the right size of market, unfortunately, even in Melbourne, that has slowed down dramatically now. And the reason being, those downsizers, they don't necessarily have mortgages. They've paid off their detached dwelling, but their dwelling is the same price as it was a few years ago. And because of cash rate rises, and typically the housing market is very much linked to where the cash rate is in terms of growth or positive or negative growth. So even the downsizers who are incredibly cautious and incredibly conservative and are wanting to protect their children's inheritance or their grandkids' inheritance are going, well, what do we do now? And a lot of those right sizers also are actually the investors, either through their super funds or through their personal capacity that actually have investments. And they're going, well, I need to now reassess everything because perhaps I've left the workforce. I need to right size. I need to also work out what's happening with all our investments. My parents, for example, are in that position where they are going, what do we actually do now? If we've got shares, if we've got investment property, if we've got money in term deposits, where are we going to actually get taxed the most or the least? So again, it also comes down to getting appropriate tax and legal and property advice to make sure that you know and understand what's going on. So those, in terms of answering your question about the assets that have probably performed the best so far, those are some of the ones that are the beneficiaries. The ones that really have been that and will continue to struggle, unfortunately, is build to sell apartments, particularly because investors, whilst they can still buy new products, typically the build to sell apartments, they strata titled area, they don't typically have land attached to them. You get capital growth in the land, whereas an apartment is much more of a yield play. A lot of people in the sector don't understand that the conventional wisdom is that property doubles every 7 to 10 years. Now, the reality is there is certain types of property like house and land or land that doubles, but apartments don't. The actual value is in the structure, which after a number of years actually gets to functional obsolescence. And so the apartment market stands to struggle because even if a new buyer goes into the new apartments, it loses that new status after a period of time. And then there's the secondary resale market that those buyers do not get the same tax advantages. And so there's discussion, and we're starting to work on a piece to try and quantify what that discount might be. It's obviously a very difficult thing to do, but a lot of the financiers have gone, all right, well, these apartments, if they get purchased by an investor, and typically after 3 to 5 years, they actually leave the rental market and they go to owner occupiers anyway. People probably haven't really understood that, and it's not really widely known, but investors historically would purchase that product. They'd get tax depreciation benefits. They could take advantage of all the incentives, and then it would exit after a few years once it had been fully depreciated and would go to the owner-occupier market. Build to sell is one that will continue to struggle. It didn't need any more challenges because of the cost of delivery and interest rates and the perception that they are all poorly built and they're going to leak, unfortunately. So buyers going into them, the government has, it's a good intention to try and get new supply mobilized by directing investors, and it's, thank goodness they didn't remove those incentives for new supply, but it's much more nuanced than I think the government's fully understood.
The question I have, Richard, do you think that what we're seeing now, that maybe the great Australian dream of home ownership is, slipping, and perhaps more people are just going to rent?
To answer your question, the great Australian dream is still alive, but what we've realized is that there's more than one great Australian dream. And again, it goes back to fully understanding the housing market. And if I unpack that a little bit more for our listeners, basically, you will have different people at different phases of their lives where they want or need different forms of accommodation. For example, a first home buyer that's not yet got married, not yet had a family, doesn't need to live in a 5-bedroom house in a school zone. A downsizer, or unfortunately a couple that one of them passes away and becomes a widow, also doesn't need to necessarily live in a 5-bedroom house in a school zone. There needs to be different types of dwellings in the same area to allow different household types to live in that area. We're already seeing that in some of the best urban renewal areas in Melbourne, Sydney, Brisbane, where you're getting additional and diverse forms of dwellings so different household types can live in them. You overlay that with the fact that in our largest capital cities being Melbourne and Sydney, 80% of the population growth are migrants. I'm a migrant myself. They bring with them their living preferences. A lot of them do aspire to have a house and land, whether it's a house and land package or live in a detached dwelling, but not all of them do. And so some of them, particularly if they've come from North America, they would prefer to rent anyway because that's what they've done there overseas, and they put their money in the share market. So the Great Australian Dream is changing. Some of it is a forced choice where the reality is it's extremely difficult to get a 20% deposit and actually suits certain people at certain points in their lives. And so that Great Australian Dream is changing.
The other sort of the second part of this was getting back to housing affordability and the cost of building new builds now.
Yes.
Is that also going to throw that into the mix, make it even more problematic? Certainly in terms of being able to people of affordability, one point, but also increasing supplies, which is intended target of these measures. And
Yep.
and did government think this would be a bit better received when they announced these measures, and would this stimulate things more quickly? Probably going against all of the observations you've made earlier on, but it seems to me that that there is reduced activity, certainly in the short to medium term.
There absolutely is, and certainly on our forecasts, and we do a lot of the forecasting, we think that in the short term, the activity is going to reduce even more. And it's not just because of these tax changes, as we discussed, it's because of interest rates, it's because of the war in the Middle East. But what we've said for a while, I suppose if we take a step back and also try to paint some context, when I think about it, for a number of years, we've been saying we need planning reform, we need tax reform, we need immigration reform, and we need basically construction reform to resolve the housing crisis. At the state level, the government is starting to do that with planning reform, and we've seen huge announcements to try and get supply mobilized. Planning, there's still a lot of resistance with NIMBYism, but at least it's heading in the right direction. Tax reform is probably the hardest one to do just because it's so unpopular, and you typically can only really do it if you're in a budget surplus. But to your comments about construction, I anticipate we're going to also see significant reform in that space. I've spoken with the Productivity Commissioner, Danielle Wood, and she's also, or that entity has put out a report on how inefficient the construction sector is. We're still building houses the same way that we did 100 years ago. So it's ripe for disruption. New South Wales seems to be taking the lead with making construction reform to support things like volumetric and modular construction, which is certainly a huge step forward because it'll decrease the costs of delivery, which right now have exploded because of wars overseas, costs of materials, labor shortages. So the reality is the federal budget has also tried to do that. You're absolutely right, with certain changes to legislation or adoption of modern methods of construction. But the reality is more needs to be done with building and construction just to work on that variable in terms of the delivery of housing.
If you were to suggest one sensible next move for people to think about in the next month as an investor or alternatively as a developer, what would you suggest people need to be doing as these changes play out over the next 12 months?
Well, I've already said this to my team. I've gone, guys, yes, you can read the media headlines and the media articles to try form your own views, but do not read it and let other people's opinions become your own opinions because they may not necessarily be correct. So right now, there's still so much stuff that's just not correct in the media right now. So even if you're reading that, then go and actually seek proper legal and tax advice to truly understand the asset class, your target buyers. Learn a little bit more about that because there are opportunities right now that do exist if you're able to understand some of that buyer behavior. So in the next month, that's exactly what I would be doing, particularly with everything still going through the Senate, and you're going to hear, as you're already hearing, there may or may not be carve-outs, certain things. Again, that just it makes things so confusing right now. So certainly I would be being proactive rather than reactive, not making knee-jerk decisions unless it's absolutely critical, and sometimes that is the case. But it's actually speaking to people that specialize in particularly tax and the legal side of things, understanding what these changes might mean. That to be honest, is the first thing that I would do right now. Quite simply, some of that advice coming back will then be going, well, we need more clarity. We need to understand what the legislation says. That's the reality. And right now, almost every day you're opening up the paper and the Albanese government is going, well, we're considering maybe carving this out, or we're maybe going to do this, we're maybe not going to do this. It's difficult to obviously give that advice, even though we're doing it right now. So what are we doing in that space? Well, we're doing scenarios, and we're going, well, what if scenarios? If this happens, let's try forecast some of the because finance, obviously, there's significant finance available right now, chasing a return, chasing investments. It actually doesn't know where to go. It's quite amazing, especially when I fly to Sydney and I speak with a lot of the private credit or even the big banks. They're going, we have all these buckets of capital, but we don't really know where to place it right now. We can't wait another couple of months. Some of them have literally said that, and I've gone, all right, well, let's work together and see, in terms of your risk-adjusted returns, let's do a worst case, best case scenario, most likely scenario in the short term until we get more certainty and more clarity, because that's what the market needs. It needs that certainty and clarity. Private capital then will price the risk accordingly. It'll go, all right, well, we know what the rules are, and hopefully they don't change. And I was terrified, and I hope that things like the grandfathered clauses come through, because one of the most catastrophic things the government could do is do retrospective changes, because that completely undermines investor confidence. And I've had a number of, whether it's the big four, even private credit, go, if that happens, how are we possibly supposed to invest in Australia if suddenly we've made investments and 20, and it's actually, it reminds me now, there are capital gains tax changes that may well impact development sites in Melbourne and Sydney that have been held in families, maybe as industrial businesses that are now being converted into residential developments, that are now caught by these changes. And that, again, is an absolute disaster. In my mind, it actually just undermines investor confidence, going, well, how can we make decisions if the government is just going to suddenly change its mind after a number of years? So I hope that the government does that as little as possible, if at all. But we need that certainty to be able to move forward.
Agree. Cameron, from your perspective, are there any critical client discussions that need to happen in the next month, or is it a bit of a longer view from a tax perspective?
Look, I think with looking at anything in terms of property, whether it's old or new, you should, recalculate the after-tax, economics before making an acquisition. But the point I will make that, property still should be judged primarily on fundamentals and all the things that said here. Tax should support a good investment, not create one. So, but I also would like to say that this uncertainty is not good. And I think there are a lot of unintended consequences, and by carving out as they go just to appease the electorate is not necessarily a good thing. So, I hope common sense prevails here, and they have some sensible consultation with people like Richard and in industry, because I can see this just becoming very, very challenging for all parties.
Richard, from your perspective or Charter Keck's perspective, is there any final thoughts or message you'd like to leave the listeners with?
Absolutely. There are a number, but the one I will leave everyone with is I hope, and certainly we do a lot of work for government clients. And what I've said to the government clients is the federal government has taken a step. Hopefully it's a step in the right direction, or it's a well-intended step. For these to actually be successful, the state governments have to come to the table, because just the way Australia is structured, and particularly when you look at the housing market and who is responsible for what tools and levers that can be pulled, if the state government doesn't come to the table, a lot of these measures will be very badly undermined, and it'll end very badly, ultimately for us being the voters. If the state governments do come to the table, and I commend, for example, the Queensland government, because the example that I can go back to is to go, well, in the federal budget, there is an infrastructure funding package, a couple of billion to basically support infrastructure works in greenfield estates, which when I speak with the industry and I do the research is a huge issue. Those land lots need to be appropriately serviced before the developers can actually proceed and sell them and get people into these estates. In Melbourne, Sydney and Brisbane in particular, a lot of them do not have these connections readily available. It sets up the preconditions for success in the housing market. That infrastructure funding package in the federal budget is actually linked to the state government also coming to the table and supporting the delivery of housing. There's a residential activation fund in southeast Queensland where they've actually started matching some of the figures for the federal government. That will then allow development and supply to occur, and that's fantastic.
And that's where we'll leave it. Richard, thank you very much for joining us.
Thank you so much for having me.
And thank you very much for sharing Charter Keck's research during the conversation. If you'd like to dig into the numbers a little bit more yourself, we'll be sharing the link to your report with the show. If today's conversation raised something close to home, the considered move is to talk it through before you act. Your Andersen advisor can help you work out what that means for your situation. A quick note, remember that everything we've discussed today is general in nature and not advice for your circumstances. If this was useful for you, please follow the Considered Move and pass it on to someone you think might enjoy it. You'll find the series at andersen.com and on LinkedIn, YouTube, and your other favourite streaming services. I'm Callen Dendle from Andersen, Australia. Thanks for listening.